A traditional individual retirement account is a tax-advantaged way to save for your future. Let's look at how it actually works. The core concept here is tax deferral, meaning you delay paying taxes on your investment gains until you reach retirement age. The IRS sets annual limits on how much you can contribute. For most people, this is $7,000 for the year 2024. You get a tax deduction now, which lowers your taxable income today, while your investments grow without immediate tax bills. The main difference is timing. Traditional IRAs give you a tax break up front, whereas Roth IRAs give you tax-free money in retirement. Because of compound growth, your money can grow significantly over decades, but remember that the government will collect taxes upon withdrawal. Keep in mind that you are essentially trading a tax break today for a tax bill later in your retirement years. Thanks for watching. Consult a tax professional to see if an IRA fits your specific situation. Subscribe for more financial basics.